Welcome back to the QX Financial podcast. Here, I'm Charity Allred, and here we have our CEO, Janko. So welcome.
Hello.
So today we are going to be talking about frequently asked questions that we tend to receive about life insurance as a product and as a protection strategy. So we dug up our very best questions. I'm going to ask them to Janko, and he's going to give us some good practical answers that hopefully will be useful to you as you start looking at life insurance and as you are planning your future financial life. The question we have is what types of life insurance policies are available and how do they differ?
Thank you, Shadi. And in big picture, there are two types of life insurance, right? You have permanent insurance and you have temporary insurance. And there are subtypes within those. So on the temporary side, we call it term insurance. Usually can go for 10, 15, 20 up to 3 years of protection. Generally speaking, has a level premium that will be fixed for the duration of the term, right? And after the term is over, either the premium goes up or the policy, dies away and the protection ends. On the other side, you have permanent insurance, and there's a lot of subcategories beneath that. But the idea is that you have a premium that you pay for the rest of your life, so you have that insurance protection for the rest of your life, right? Some policies can be guaranteed. They're guaranteed to pay out if you pay the premium, such as whole life, for example. And the other ones can have additional risk involving that, like universal life, index UL, variable universal life. Again, we don't have to go over the details today, but the thing to remember is that you can buy protection that is permanent, or you can get protection that is temporary, and the costs and the premiums on those obviously will differ depending on the length and the permanency of that protection.
Great, thank you. So the next question we have is, how do I determine the amount of coverage that I need?
We do something that is called a life insurance needs analysis. For a lot of people, they like to use rules of thumbs or just round numbers, and that's probably not the best way to go about it. So I will highly encourage you guys to either reach out to us so we can do an analysis for you, or you can go online. There's a couple of calculators out there that can be useful, so you can do your own analysis. But the idea is that you understand your liabilities, right? If something happens to me today, that should be what the client asks him or herself. If I cannot earn an income today because I die, I get to pass away, what are my liabilities? What am I trying to protect? What things do I need to see happen or need to happen after I die that needs to be funded? And that could be education for children. It can be room and board for the family. It can be the mortgage. It can be to pay off debt, or a combination of all that put together. Income replacement, as I mentioned earlier. So that's why it needs a careful analysis to get to the right amount. But I can tell you this: most Americans, buy 50,000 because that's what they get from work, or they get 100,000, from their company because that's what is offered for free or with a car insurance. For the 99.8% of the people out there, that is not going to be enough.
Next question we have is, what factors affect the cost of my life insurance premium?
There are quite a bit of factors, but two main ones that people should know are their age and their health. When you apply for a life insurance contract, for a life insurance policy, there is an underwriting process that takes place. And during that process, it is determined your level of risk, right? So obviously, if you're young and you're healthy, you're going to have a lower premium than if you're older and unhealthy. That's obvious. But the extent to which those things will happen, it 100% depends on the underwriting process. So what I can tell you is, don't rely on the TV ad. You can get $1 million for $20 a month, or the online ads that you see on Facebook from certain fintech life companies, like, oh, $20 for $1 million. Yes, if you are 21 years of age and you are like Superman, sure. Doesn't mean the life insurance is expensive, however, it's not. But the only way that you can actually measure your level of risk so you know what your cost is going to be is by putting yourself to an underwriting process. Now, last thing on this, there's a lot of companies like the ones that we work with that now they have algorithm underwriting. So you can get approved without an extensive underwriting process because companies have gotten really, really, really good at measuring and managing risk when it comes to life expectancy. So again, reach out to a professional agent. We're happy to help you as always. But if not us, reach out to a professional agent that can actually do this work for you and show you your options. And that way you can get priced correctly.
Perfect. Thank you. The next question we have is, can I convert a term life insurance policy to a whole life policy?
The short answer to the question is yes. In most of the times you can, if the product is being offered. People tend to think of term insurance as a commodity because it's fairly inexpensive. Lots of companies offer it. But when you're looking at benefits, especially conversion privileges, it is important that you, as a consumer, as a client, get that term from a good, high quality company. Why? Because you want to have something to convert to. So what do I mean by that? What you see with a lot of young people is, they don't have a lot of money, right, to spend on insurance, let alone life insurance, but they have kids, they have a mortgage, they have responsibilities, financial obligations they want to make sure they're taken care of if the unthinkable happens. So that's why term insurance is very appropriate for them. You can get a lot of coverage for a low amount of premium. I mean, I have clients in their 30s, with a couple 100,000, sometimes more than $1 million for under $100 a month, right? So very inexpensive in relation to their incomes and their liabilities. But it doesn't last forever, right? And so sometimes people get through life and there are some commentators out there in the financial space that like to paint a picture where life goes perfectly, right? You go to high school, graduate, go to college, marry your high school sweetheart, you have two kids, get married, buy a house, and then they go to college, you retire, and happy ever after. But I think you listeners out there that are listening to me talk right now may agree with me that life never goes that way, right? In this fantasy world where some financial commentators live, there's never a divorce, there's never a death in the family, a child never gets sick, and you never have unemployment, there's never financial recessions, and so on and so on. So my point with this is that your need for coverage for liabilities do change over time. The grand majority of Americans, for example, never pay their mortgage off before they retire. So you still have financial responsibility that need to be covered. But term may not get you all the way there. Again, if you're a 30-year-old and you buy a 30-year term, you're still working when the term is off, at least on the average. So what is the point of conversion? To take a portion, if not all of the term, and convert it into a permanent policy. But if the company you are with doesn't offer any conversion or any products to convert to, then you're out of luck. So yes, term can be converted for sure. Is Most companies offer that, but the key that you have something, they need to offer you something to convert to, and a lot of companies don't offer that. So make sure that you are with a reputable company, even though you're buying term, get it with a good high quality company.
Great answer. All right, the next question we have is, how does cash value accumulation work in a whole life insurance policy?
When you buy whole life, you're buying a permanent contract. That means you're going to have insurance for a long time. And the premium of forever, not a long time, but for the rest of your life. And you're paying a higher premium than when you buy term. There's no question about that. Sometimes it can be 3, 4, 5, 6 times higher than regular term insurance. So there has to be an incentive for you as a consumer to pay that additional premium. And that's what this cash value is. Any excess to the cost of insurance that you're paying today, you're being rewarded by creating a source of savings account inside your life insurance. And an additional benefit of that is that you also get a return on your money. We call that a dividend. Some other policies offer a rate of return. So you get incentivized to put those additional funds. And the end result of this, what happens is over time, you actually end up accumulating more than what you put in, right? Again, there are some financial commentators out there and they say, oh, that doesn't work. It's not true. It's just a return of what you put in. Not necessarily. If the policy is properly designed with a high quality carrier, then you actually over your lifetime end up with way more than what you put in. At least that's the objective. So in a way, you are prepaying the coverage up front, but you're getting a reward in the liquidity, which is access to your money, also in the earnings or dividends of that money, and also, and probably the most important one, you get a tax subsidy to do so, meaning that you get to use that money, if used correctly, 100% free of any income taxes. So that tells you that what the government wants you to do is to protect yourself so your family doesn't go back into government care, right? So you have financial incentives to do so. So for the right person, those financial incentives can mean a lot, a great earnings of money over their lifetime.
Okay, great.
Mhm.
This is a question that we get a lot. What happens to my policy if I miss a premium payment?